The overall stock market has seen a huge rally, with the S&P being up over 10% this year and the Nasdaq being up over 27% this year. With a debt ceiling deal being right around the corner, will this send stocks higher or will it cause a big dip in the market? Let's find out. In this video, I'm going to be talking about how a debt ceiling deal could potentially reverse the big jump in tech stocks, as well as compare the debt ceiling to 2011. I'm also going to be doing some technical analysis on the S&P 500 and the Nasdaq, and also be talking about where Bank of America thinks you should be selling your stocks. So jumping right into it, we have this article here from Yahoo Finance, how a debt ceiling deal could reverse the flight to big tech stocks like Amazon. So a potential deal to lift the U.S. debt ceiling could spur money managers to pair holdings in the massive technology and growth stocks that have been havens this year and shift into the rest of the market, some investors believe. So the debt ceiling is going to reach a deal pretty soon here, by at least June 1st. And it's been really clear that mega cap stocks such as Google, Microsoft, and Amazon have been attractive places to hide over the last few months, as investors have been worried about everything from debt ceiling to a big US banking mess. So these mega cap tech stocks have command a heavy weighting in major indexes like the S&P and the Nasdaq. Their rally has been responsible for the 8.3 year-to-date gain in the S&P 500 through Wednesday's close. Now we're up even more year-to-date, putting us at about 10%. So should a deal on the debt ceiling be reached, which most people think we are going to reach a deal, the pattern that we've seen over the last few months will reverse, said Michael O'Rourke, chief market strategist at Jones Trading, who is more bullish on equal-weighted S&P 500 exchange-traded funds than the market-weighted cap index. So a recent study of global fund managers from BofA Global Research showed that 71% believe a deal to raise a debt ceiling will be reached before the X date, with the X date being June 1st. So clearly we think that we're going to be reaching a deal. Biden has been in talks, and congressional Republican Kevin McCarthy both expressed confidence on Wednesday that a deal would be reached, which would obviously avoid a massive catastrophe in the financial markets. So if you take a look here at this chart, we can see that Meta, Google, Amazon, Apple, Microsoft, Nasdaq, Netflix have all severely outperformed the S&P 500 this year, which is not uncommon, but there's a big discrepancy here that we can see, right? So why is that? They've been a nice place to hide, and people are expecting some movement back into treasuries because you're getting a nice yield, and some other parts of the equity market have lagged behind. So to me, obviously it's not financial advice, but this makes a ton of sense. Being someone who understands tech stocks quite a bit and parks his money where he understands, I obviously am a big investor in tech stocks, but I do understand that we've had this huge rally here that has all been predicated on what we think is going to happen this year in the future. But with that being said, after a big rally and some unconfidence in the market, like the debt ceiling, the banking crisis, inflation, interest rates, it makes sense that investors would shift towards treasuries or even money market accounts to get some easy guaranteed yield, or even shift to other sectors in the market, right? So of course, investors are unlikely to abandon tech stocks entirely. As you guys know, there's been a ton of excitement over artificial intelligence, which has boosted some of these mega cap names. But at the same time, the debt ceiling has been one of the several worries weighing in on the market. Concerns that the Federal Reserve's aggressive monetary policy tightening could reduce economic growth, and worries about the recent tumult in the banking sector are likely to remain even if a default is avoided. So personally, I think they will avoid a default, but there's still tons of other things that people are worried about when it comes to the economy. So where else should you potentially be looking at to park your money? Well, in recessionary times, people look to healthcare to be a bullish sector. Like I said, money market accounts. People are just trying to get any sort of yield right now without taking on too much risk. And it would make sense for people to go risk off after such large cap, mega cap names have had huge run-ups this year. So it's been a very tilted market, he said. We think investors are going to look through this soon and try to find areas that are going to generate revenue if growth comes down. So this doesn't mean you should totally sell to cash or totally do nothing, but it does mean that you should do what's best for you. Obviously, if you have a long time horizon, probably doesn't matter if you're just heavily invested in tech stocks right now, if you can wait 10 years, let's say. But if you're going to be retiring in a few years, you might want to go a little bit more risk off and think, hey, maybe I need to go a little bit more in cash. I need to have a little bit more in my emergency savings funds. These are all things to keep in mind And you have to understand that it's not one size fits all when it comes to personal finance and investing. You have to make that decision for yourself. So definitely do your own research. But let's talk about 2011 and see if this sell-off shows any similarities to this 2011 sell-off after the debt ceiling window. So stocks dropped almost 20% in 2011 after a debt ceiling deal was reached just before the expiration, the X date. So the Treasury market performance highlights a significant difference between 2011 and 2023. So definitely don't just panic and think that's going to be the same situation as 2011, because there's definitely a very different economic landscape. And then 2023 credit markets are telling us to monitor the S&P 500's still constructive trend with a more skeptical eye. So in 2011, the poster child for poor debt ceiling outcomes in 2011, when the S&P dropped 20% from the May intraday peak to the October closing low. So we can see here that this peak here, and then we saw this big drop, and this was right around when the debt ceiling deal was reached, and we saw a big drop. So the European debt crisis was another major factor contributing to the 2011 sell-off. So obviously Europe is pretty stable right now, but there is all this unconfidence in the banking system, inflation, interest rates, all these different things. So ultimately, market sell-offs are based on a tipping point between the acceptance of risk and risk aversion. Thus, with the 2023 debt ceiling X date fast approaching, it's prudent to compare the profile in 2011 to the 2023 profile. So 2011 was a different animal, and we can see that here from these two charts right here. So let me explain that a little bit. The performance of TLT, US Treasury bonds, in 2011, which is this top chart here, relative to their performance in 2020 to 2022 to 2023, highlights a significant difference between the two periods. The demand for safe haven treasuries was increasing for 5 months prior to the July 31st, 2011 debt ceiling agreement. So we can see here that the TLT chart was kind of slowly increasing up until this point. In 2023, though, it's a very different case. The demand for TLT has been tepid, especially over the past 6 weeks. This is possibly reflecting concerns about the long-term imbalance between tax revenues and future entitlement. So we can see here that we've been actually dropping here for the past 6 weeks. So these charts are very different from 2011 and 2023. Also in 2011, they came to an agreement on Sunday, July 31st, which was just a few days before the X date. Rather than rally, stocks sold off hard in early August 2011. So you can see this chart below. We kind of had this peak here in May, a big drop off, a little pump up, and then this huge drop off right after the debt ceiling agreement. So the S&P's intermediate trend was weakening for approximately 2 months, so you can see that here, before the July 31st debt ceiling agreement. In contrast to that weakening trend, we have this uptrend here in 2023 that you can see even from back in November or even October. So that's clearly a very different trend. And like I said, it's nothing to necessarily panic about and, sell your whole portfolio or, completely rebalance, but it is something to keep in mind. Let's also talk about the credit markets. So in 2011, the AGG versus IEI ratio peaked well before the July 31st, 2011 debt ceiling agreement. So we can see the peak here was back in April. 2023 looks completely different. The peak is back here, way back here last year, as far as this chart shows us. And also we've been seeing a big sell-off here in this chart. So it's had a constructive base building until late 2023. In the last 2 weeks, the chart started to break down, reflecting concerns about numerous topics like we talked about earlier: debt ceiling, earnings, and default probabilities. Another thing to keep in mind is the political climate. Market participants may be in for a volatile ride in the coming weeks. In the long run, the most likely outcome is a resolution to the current debt ceiling. I definitely think they're going to reach a resolution before June 1st. I'm fairly confident on that. But you have to keep in mind the political landscape is the win the next election mentality in an increasingly hostile environment in Washington. It's possible that the gamesmanship will be taken a bit further than in past with the debt ceiling episodes. So far, equity markets have held up well. We saw this big bump from Wednesday in the NASDAQ and the S&P as Biden talked about getting closer to reaching a deal. Investors were pretty happy about that, of course, but you have to keep in mind that's just the short-term impact. You have to think a little bit more long-term. So the credit markets are still telling us to pay closer attention while respecting a broader range of outcomes. So definitely something to keep in mind. I did want to go into the charts here of the NASDAQ and the S&P. So you can see that the NASDAQ, peaked out here at the end of 2021. We had this big decrease here, and we kind of bottomed out at the end of last year. And since then, we've kind of double bottomed here again in January, and we've had a big pump from about 258, 260 to 337 where we are now. One thing to keep in mind, obviously indicators are not just going to be some magic thing where people are going to completely respect these indicators and use them to navigate their portfolio. But you can see here with RSI, when it's above 70, that means it's overbought. And we're looking at the 4-hour chart here on the NASDAQ. So clearly we are overbought on the NASDAQ. So that could be signaling that it might be a decent time to maybe take some profits or rebalance. When we take a look at the S&P on the 4-hour, it shows slightly different. We're not as overbought. We haven't hit that 70 level, but same type of deal here. We kind of bottomed out last year here in October, and we've been slowly bouncing back up. The NASDAQ is a lot more weighted in tech stocks and has the top 100 stocks, whereas S&P has the top 500 plus stocks. So it's a little bit less risky when it comes to comparing the two names. Well, let's take a look at this Bank of America kind of analysis and what they are saying about the S&P. So we're really coming close to this 4,200 level. We just hit it actually right now as we speak. And right now it's currently 9:41 a.m. on Friday. So Bank of America was saying S&P 500 should be sold above 4,200. So why is that? Well, it's because for the first time since 1981, every U.S. yield curve has been inverted for over 6 months, he says. And in the past 100 years, the current 170 basis points of inversion between the 3-month and the 10-year yield has been exceeded on just 125 days. So what all does that mean? Essentially what it means is that such a move could suggest a recession is imminent, says Harnett, who offers up more signals supporting this scenario. In summary, Harnett says that the expected macroeconomic and market chronology of the past 18 months, inflation shock, leading to rate shock, a bear market and a recession, Fed cuts, and then a bull market. See, people really thought this was programmed, and everyone is kind of predicting this to happen, but he is saying that this has been completely interrupted now. So it's something to keep an eye on that, Bank of America is saying that people should sell S&P over 4,200. Like I said, you need to make these decisions for yourself and not just follow what big banks or hedge funds are telling you to do. Everyone has different risk tolerance, wants, needs, etc. So kind of take this with a grain of salt, do your own research, and kind of come to a conclusion of what works for you. I really appreciate you guys watching. If you guys could like, comment, and subscribe, that'd be really, really appreciated. Have a good one. Thanks.